When you run a business like I do, the idea of running a business is that you make a profit, which is essentially at the end of the year, you have your expenses and whatever is left over should be your net profit. Now, hypothetically speaking, if someone has a business and it does $1 million in profit, so after they paid all their expenses, there's $1 million left off. Generally what happens is they will get to the end of the year or the end of the financial year, say, May or coming into June, they meet with their accountant and they say, this $1 million that I have as profit, I'm gonna pay tax on that money. And inside of Australia, company tax on earnings is 25 cents in every dollar, which means on this $1 million, you would pay $250,000 of company tax, and you would be left with $750,000 of net profit after tax. And what most business owners do is they say, I don't want to pay this $250,000 of tax because I don't want to give my money away. So how can I make this number lower to go from $1 million to say half that and only pay tax on $500,000. And generally, the way that people do that is they go and buy equipment, for example, for their business, or they will go and spend money on things to be able to bring their overall net profit down. So they add more expenses to their profit and loss. They bring their number down, and then essentially they will then only pay tax on the $500,000, which would be half this amount. So they'd only pay $125,000 in tax, which at a high level looks like the right thing to do because you're paying less tax, which means there's less money going out. You're buying things that your company may or may not need, and it looks like a short-term win. But essentially, what is happening by you decreasing this number from $1 million down to $500,000 is you are decreasing your ability to create real wealth. And you're not only decreasing your ability to create real wealth by half, which is what you're trying to minimize your tax by, you're decreasing your ability to create wealth by millions and millions and millions and millions of dollars over a long period of time. And I'll show you what I mean by that. Essentially, when we're looking at creating wealth and we're using real estate as the investment vehicle, there's three main things that we look at. We need to have the income, because income is the thing that allows us to go to the bank to be able to borrow money. We have borrowing capacity, which is essentially how much money that bank or lender will lend us based on our income. And then we have the assets we can buy with the borrowing capacity and the income that allows us to get that borrowing capacity. So in the example that I just showed, we had $1 million in net profit, okay? So if we look at our income here, it's $1 million. Based on that $1 million, depending on the lender you go to, you will be able to borrow roughly 5 to 6 times that amount. So 5 to 6 times, we call that a debt to income ratio. So if we look at that $1 million and we times that by 5 or 6 times, let's take a midpoint at 5.5 times, we would be able to borrow $5.5 million in debt. So the $1 million gets us $5.5 million from the bank, and that would then allow us to go and buy assets. And we could then use this $1 million of cash that we have as profit, or if we had other assets, to then go and buy $6.5 million worth of assets. So if we have $6.5 million here of assets. By getting $1 million of profit, we then get $5.5 million from the bank, which then allows us to go buy $6.5 million worth of assets, because we combine our borrowing capacity with our profit that we have if we're using cash out of a business, or we could potentially be getting equity from other assets. If we were to go and do this, hypothetically speaking, we'd have to obviously pay our tax on our $1 million, which, like I said before, is $250,000. We'd be paying $250,000 worth of tax to go and buy $6.5 million worth of assets. Now, over a long period of time, if you look at the Australian property market, you look at residential assets inside of the Australian property market, they have grown at just under 7% per annum. So if we go and buy our $6.5 million worth of assets, and that grows at the long-term Australian average of 7% per annum, we will be making $455,000 per year in growth. So let's say that we go and buy our $6.5 million worth of assets, and they grow at the long-term growth rate in Australia, which has been about a 7% compound growth rate, which means in the first year, we would make $455,000 of growth, and every single year, that would compound at 7%. Now, if we held these assets for say 15 years, that $6.5 million, if I look at my compound interest calculator here, would turn from $6.5 million to $18,158,000 and some change. So we turn $6.5 million into $18.158 million, which means we have a total gain of just over $12 million. So by paying $250,000 of tax on $1 million of net profit, because you pay 25% on your tax inside of a company, that allows us to go borrow $5.5 million from the bank, combine our cash or equity that we have with that to buy $6.5 million worth of assets, and after 15 years, we end up with $18,158,000, of which $12 million of that is profit. If we didn't go and pay that $250,000 of tax and we couldn't get the $5.5 million from the bank, and let's say we decreased our profit from $1 million to $500,000, let me show you the difference, because most people think, well, the difference is I've saved myself $125,000 because I've paid half as much tax as I needed to. But the reality is they have cost themselves millions and millions of dollars. If we go back and we look at our three keys: profit or income, borrowing capacity, and assets. So instead of having $1 million of income or $1 million of profit, we wrote that down to 500K. And the good thing is, in people's eyes, that they saved $125,000 in tax because they didn't pay tax on $1 million, they only pay tax on $500,000. What that's then done, if we use our borrowing capacity calculation of 5.5 times debt to income, so 5.5 times income is what they will lend us in debt, that means that they will lend us $2.75 million in debt, which would allow us to then go and buy about $3.25 million worth of assets. Because we've got our $2.75 million that we're getting from the bank, we'll then combine our $500,000 of cash we have for the deposit, which would then give us $3.25 million worth of assets. So remember, we've saved $125,000 in tax because we only paid 25 cents in the dollar on 500 grand, as opposed to paying 25 cents a dollar on $1 million, and we've gotten to $3.25 million of assets. Now, all of the other assumptions we're going to make are the same. We're going to have the same 7% growth rate. We're going to have the same time frame of 15 years, and we will see whether we have actually saved $125,000 or whether we have cost ourselves millions of dollars. So we have our $3.25 million worth of assets. They are then growing at 7% per annum, and we're holding those assets for 15 years. Now, if I get my little compound interest calculator up here, and I am on the Money Smarts website as well, we're on $3.25 million at 7% compounding. That takes us to a grand total of $9.26 million. So we've got our $3.25 million at 7%, which has then taken us to a grand total of $9.26 million worth of assets. And that has given us a grand total gain of $6 million in profit. Not a bad outcome. We invested 3.25, we ended up with $6 million, and 15 years ago, we only paid the $125,000 of tax as opposed to the $250,000. But let's compare the two side by side. Let's compare the 3.25 million turning into 9.26 and getting a $6 million in profit, or having the $6.5 million growing at 7%, turning into $18 odd million, and you can tell me which one you'd rather have. In our two scenarios here, we have income. We'll do the first column. We have $1 million of profit, and we'll have our second column at 500K of profit. Now, in these two scenarios, if we were to have $1 million of profit, we're going to pay $250,000 worth of tax on this one, and on this one, we're only going to pay $125,000 worth of tax. So far, we're $125,000 better off here. Now, our borrowing capacity on this one is going to be $5.5 million bucks. And in this one, we're going to have $2.75 million worth of borrowing capacity. That's then going to allow us to go and buy assets up into the value of this one being 6.5 million, and in this one being 3.25 million. So far, the only thing that is different really in terms of money out of our pocket is the taxation. But after 15 years, let's see what the growth rates are between the two. So on this one, we've got 9.26 million. And in our chart here, we have 18.5 million. And if we go all the way to the bottom here, which may be hard for us to see, we then have our profit, which in this one is 12 million. And in this one is 6 million. $1 million in income versus $500,000 in income. We're saving $125,000 in tax, but as we move down here, we end up with 15 years assets at 18.5 million or 9.26 million. The net number at the end is not $125,000 worth of savings. The net number at the end is it's cost you over $6 million by not paying the extra $125,000 in tax. Because if you use your money to go and invest in assets, leverage the bank's money, and go and buy real estate, the real estate over time grows in value. And the difference between $1 million in income and $500,000 in income is double the amount of serviceability. And double the amount of serviceability means you can go buy double the amount of assets. And buying double the amount of assets, is if all things remained equal, means you're going to get double the amount of growth over the same period of time. And double the amount of growth means 18.5 million worth of assets versus 9.25, which is $12 million worth of profit versus $6 million worth of profit. And even if we add in the extra $125,000 to the 6 million, it means your 6 million is going to go to 6.125 million, and your 12 million is still going to be 12 million. So if I was to show you this right now, before you go and pay your tax or before you finalize your numbers to submit to the ATO, would you ask your accountant, how do I decrease my taxable income? Or would the question to your accountant be, how can I maximize how much tax I pay so I can show the maximum amount of income so I can go and buy the largest portfolio or go and build the largest portfolio I possibly can? And this is fundamentally the thing that I constantly focus on every single year. It is, how do I make as much income as possible by adding as much value to people as I possibly can within my business? How do I only put my business expenses through the business so I can make my business as profitable as it can possibly be? And when I have a profitable business and I have the cash flow and I have the capital that I need to be able to go buy assets, how do I then get as much money, being borrowing capacity from the bank, to then go and buy assets? Because I know by paying tax right now, it's going to compound over time and it's going to make me tens of millions of dollars. And that's how I've been able to compound and build a $35 million property portfolio before 28. So let's look at my current portfolio. If we just use the same assumption as we were before. So now I've got $35 million in assets. Let's assume that 35 grows at 7%. So 35 million growing at 7% per annum means the portfolio over a long period of time is making $2.45 million per year in capital growth. And obviously as that compounds over time, it becomes more and more and more. If I know that I'm making $2.5 million a year in growth from the portfolio, and that $2.5 million I could use as deposits to go buy more assets, and let's assume that $2.5 million is a 20% deposit for whatever I buy, I could essentially use that $2.5 million to go and buy another 10 million bucks worth of assets. Because the 2 million to be the 20% deposit on the 10 million worth of assets, and the 450 grand will be the stamp duty I need to pay to buy the 10 million bucks. So I've got the growth sorted to go and buy 10 million bucks worth of assets every single year if I wanted to. And then I look at, well, if I can go and buy $10 million worth of assets, how much income do I need to be able to then go and get the debt, which would be 8 million on this 10 million, to go and get the 8 million from the bank to then buy the $10 million worth of assets. And then I reverse engineer it. If I need borrowing capacity, BC, of $8 million, and I know that the banks will lend me roughly 5.5 times my income, I know that to go and borrow 8 million bucks, I need roughly $1.5 million extra of net profit to be able to go borrow the $8 million. So when I get to the end of financial year and I've got $1.5 million of net profit sitting there, do you reckon that I'm trying to get that $1.5 million down to $750,000 so I don't pay as much tax on that? Or do you think that I'm trying to push that $1.5 million as high as it can go from a net profit point of view, because I know then I can go and buy another $10 million worth of assets growing at 7%, which is then making me $700,000 per year in growth. over a long period of time. And this is fundamentally the mindset and the strategy that business owners should be using, because eventually you're going to want to get out of running your business. And 1% of businesses in Australia, or less than 1%, ever sell for an amount that will actually allow you never have to think about money again. And most businesses, when they even go for sale, never even sell. So there is a high probability that your business is worth nothing and no one will ever buy it. So if that's the case, when you ever want to get out of it, the only way you're going to be able to get out of your business is to have assets that will allow you to get out of your business. By not paying tax, you're actually doing your future self a disservice, because you're not allowing yourself to get the compounding vehicle behind you through real estate or other asset classes that'll actually get you out of the game. There are some assumptions in here that we have to make. We have to know that property is going to grow at 7% per annum in the future. But if it's done it for the last 100 years, would you not rather bet with the past as opposed to bet against it? We have other things like holding costs, for example. We have to make sure we can hold the properties and cash flow the difference between the rent and the mortgage. But if you've got a profitable business, making $1.5 million a year, do you think you've got any issues with cash flowing properties? Probably not. So this is the game. Use your taxation position to be able to build wealth and stop worrying about trying to save the pennies and worry about focusing on making the dollars. Like, subscribe for more of this content, folks. See you on the next one.